everyone. We will be starting the session in another 5 minutes.
That's it. We can start in five.
Uh, sir, let us start now. I think few people are also watching on YouTube and Facebook, so it will gradually increase. So let us start now. So, good evening, everyone. First of all, I welcome you all who are attending this session by means of Facebook, Zoom, LinkedIn, YouTube. I see Aditya Agarwal on behalf of Professional Times. Welcome you all in this foreign trade policy series. Uh, Today topic is introduction to foreign trade policy, SEIS, MEIS, now RoDTEP. Uh, I know we have launched this series. I think in a so much pressure time for all the CAs. Uh, Due date is 31st of October. Uh, Let it be tax audit, GST audits, ITR. So it is very challenging for both the audience and I think also the speaker Saurabh ji, uh, who is giving us his precious time on our channel on regular basis. Uh, just to give a short brief about him, he is a renowned chartered accountant and a law graduate. Uh, he was associated with EY India as an associate director. He was also associated with Lakshmi Kumar Sridharan. He is a national faculty for indirect tax with Institute of Chartered Accountants of India, and he's deliberating at various platforms, whether industry platforms or institute platforms. So, I welcome you, sir, on behalf of Professional Times,
Thank you,
and
sir.
happy Navratri to all. Today is a very holy day and a very important day. So, let us start today's session with a small positive thought that don't downgrade your dream to match your reality, upgrade your faith to match your destiny, be happy always, and we have to remain positive. Uh, because we have a lot of pressure, whether it is professional pressure or the most important pressure, that is health pressure. So we have to remain safe, calm, and most important, positive. So I'll not take much time, and over to you, Saurabh sir, for his deliberation.
Thank you, sir. Thanks, Aditya. I'll just quickly share my screen and start with the deliberation. Good evening, everybody. I welcome you to
Just a
the.
second.
Yes, sir. Yes, sir.
To all the
Yes, sir.
viewers, we can take questions, I think, at the end of the session, and
Sure, sure,
the viewers can write on the chat box or in the YouTube comment, and we can consolidate all the questions at the end, and that can be taken up by Saurabh at the end of the presentation. You can continue, sir.
sure. So, I welcome you all to the foreign trade policy series started by Professional Times. Just to basically tell you the flow and the structure of the series is divided into four seminars, which are scheduled. One is today, the second one is tomorrow, and the other two are on the next weekend. Now, the whole structure is divided into the first part, second part, third part, and fourth part. Basically, these are nothing but different chapters of foreign trade policy. First chapter or first part being covering the basics of foreign trade policy, and basically chapter 3 of foreign trade policy, that is duty reward schemes. Second part would be covering more of EPCG and custom bonded warehousing manufacture, that would be covered in the second part, that is tomorrow. Third part would cover EOUs, STPs, EHTPs, BTPs. So that would be third part, that is next Saturday. And the fourth one would be on advance authorization on DFIA, duty free import authorization, and deemed exports. That will be on Sunday, the next Sunday. Now, we have to start with some basics of foreign trade policy and then jump on to the specific chapter of duty reward schemes under the foreign trade policy. Now you must be wondering why foreign trade policy. Maybe you're not wondering, also you know this, but why foreign trade policy? Because our foreign trade policy is usually for 5 years, and it is due for renewal, or it was due for renewal from 1st April 2020, but due to this ongoing pandemic, it has been deferred to 1st of April 2021. So because of this change that would be coming in the foreign trade policy, as also a WTO dispute wherein India has lost a case filed by basically USA against our foreign trade benefit scheme. The relevance of understanding the foreign trade policy becomes much more than usual. Now, we will just go through some basics in the first 5, 6 slides and then move on to the reward scheme. Now, unlike various other indirect tax laws, and today we have only two indirect tax laws left with us, that is basically GST and customs, which is handled by the, or which is administered, governed, or regulated by the Ministry of Finance under the Government of India. Foreign trade policy is governed by Ministry of Commerce and Industry. So the administering ministry is Ministry of Commerce and Industry in terms of foreign trade policy. Now, foreign trade policy is a policy document which is framed and published under a legislation. And the primary legislation concerning foreign trade is Foreign Trade Development and Regulation Act 1992. Now, this act, in short, is usually called as FTDR Act. This is the primary legislation under which this foreign trade policy is framed and published. Now, we will go from the origin. We start from the origin. So, we are starting with FTDR Act. Basically, FTDR Act, if you read the preamble of FTDR Act, it provides for development and regulation of foreign trade by facilitating imports. Now, you must stress on the word facilitating imports and augmenting exports. So, the basic premise or the basic objective of foreign trade policy or FTDR Act is to facilitate imports, to make them smoother, and to augment export. That means to encourage exports and other incidental matters. Basically, under the FTDR Act, the provisions are in relation to facilitating and controlling foreign trade, to prohibit, restrict, regulate exports and imports, to formulate the foreign trade policy, and to appoint a DGFT, basically the DGFT department who would or which would actually administer the foreign trade policy and the related rules, which are called Handbook of Procedures. So FTDR Act basically has these four functions, basically has these four parts. Now, Section 5 of the FTDR Act empowers the central government to formulate and announce by way of a notification in the official gazette the foreign trade policy. In that section, Section 5, there is a proviso, and this proviso mentions that provided that the central government may direct that in respect of SEZ, the FTP shall apply with such modifications, exceptions, and adaptations as may be notified. Now, you must be wondering why this proviso. We all know provisos are for three purposes. Provisos are for three purposes: to give a clarification, to provide for an exception, or to put out a condition. In this case, it is creating an exception. What is it saying? It is saying the foreign trade policies provisions would apply to SEZ in a modified or a adapted manner. Why? Basically, the origin of this proviso is that SEZ provisions relating to SEZ scheme was contained in the foreign trade policy prior to 2005. In 2004-5, these provisions were taken out of from the foreign trade policy and were taken to a separate legislation for SEZ called the SEZ Act 2005. And that is why it says that the provisions of FTP, so far as they may apply to or they have to apply to SEZ, will apply in a modified and adapted manner, because there is already a separate legislation for SEZ. And that is why, while I was telling you the framework of the discussion that you would have in the FTP or for the FTP, I did not say SEZ, because SEZ is no more a part of FTP, but is a separate legislation altogether. Now, one of the basics for foreign trade policy is that foreign trade policies are issued for 5 years. The policy that we are sitting on today as on date is Foreign Trade Policy 2015-20. This policy was otherwise valid for or valid till 31st March of 2020. However, due to this pandemic, this has been extended till 31st March of 2021. So the new policy is expected from 1st of April 2021. Earlier, this policy, which is now called the Foreign Trade Policy, was also called EXIM policy, because the scope then was very narrow, only exports and imports, and scope now is much wider. So that is why the name has been changed, terminology has been changed from EXIM policy to Foreign Trade Policy. Now, some of the basic features of this policy are, before we go to the policy and go to the relevant chapter of the scheme that we have to discuss today, the basic feature of this policy are that foreign trade policy provides for various provisions, schemes, benefits, restrictions, various things. In line with that foreign trade policy are benefits, restrictions provided in the respective taxing statutes. That is, you may have provision under the customs law, you may have provision under the GST law, you may have provision under the FEMA Act, various. various acts in line with foreign trade policy. The basic feature is that if there is a contradiction between what is provided under FTP and what is provided under these acts, the act shall prevail, the legislation shall prevail over the foreign trade policy. Another basic feature of the foreign trade policy is that exports or imports of goods or services into India or from India is generally free. So India being part of the global village, and we want to integrate ourselves in the world and not have trade and tariff barriers for import and export, the general policy is that import and export should be free unless specifically regulated as by the foreign trade policies and various other laws. So the basic feature is that this should be free. Import and export should be free of trade and tariff barriers. Another very basic feature of our foreign trade policy is that when we export the goods or the services, we only want to export the intrinsic value of the goods or the services and not the taxes embedded in those goods or services. That is the most basic feature of the foreign trade policy in terms of taxation laws, I'm saying. So in terms of taxation laws, in terms of taxation on exports, the basic feature is that when we are exporting goods or services, we only want to export the intrinsic value of the goods or services, the profit margin whosoever is exporting wants to earn on it, and that is all. The complete taxes in the value added chain should be refunded or given back or exempted to the person who is exporting, and only this value shall be exported. Taxes should not be exported. Another feature, or I would say objective, or I would say goal of foreign trade policy is that it should provide a single window scheme to the importers and exporters to either file their bill of entry and get the goods cleared, or file their shipping bills or bill of export to get the goods exported. And the latest addition to the features of foreign trade policy, and that would reflect in various provisions of the foreign trade policy also, along with the notifications and public notices and customs law notifications, is Make in India. So one of the basic features now of the foreign trade policy, and the recent feature, is that it is promoting Make in India. Now, in terms of department, or in terms of the government department which is to administer foreign trade policy and the related provision, is the Directorate General of Foreign Trade. Where is it located? It is located all over India through its RA office, regional offices. Its headquarters is in Delhi, near Central Secretariat in Udyog Bhavan. So in Udyog Bhavan is the headquarters of DGFT, wherein the head of DGFT sits, and then there are various RA offices, be it in Delhi, be it in Jaipur, various states, wherein the branches of this DGFT offices is located, wherein various assistant DGFT or deputy DGFT would, and various other officers would sit. Another feature of foreign trade policy in terms of administration is that matters decided or to be decided by a DGFT department, the decision of the DGFT department is final and binding. That is the foreign trade policy or the handbook of procedure, that is the complete law relating to foreign trade policy, does not provide for a appellate mechanism in terms of an appellate tribunal within itself. It provides for an appellate mechanism in terms of a quasi-judicial authority of a first appellate authority, wherein maybe a deputy DGFT or DGFT would sit in an appeal against an order passed by a lower officer, but there is no mechanism of a tribunal. So once a decision has been made within the department of DGFT, the only recourse that a person would have would be a writ before the relevant jurisdictional high court. So there is no appellate mechanism as we find in customs law or maybe GST law. That appellate mechanism in terms of appellate tribunal is not there. There is one appellate mechanism, but that is only internal to the department of DGFT. And that is why it is said that the decision of DGFT in respect of any matters to be regulated and administered by DGFT is final and binding. Unless obviously you always have Article 226 and 227 to your rescue, wherein you can approach the High Court in its original jurisdiction and challenge anything and everything under the sun. Now, administration of foreign trade policy is not just uh, uh, focused to or restricted to DGFT. A part of it is also done by RBI, a part of it is also done by CBIC, Central Board of Indirect Taxes and Customs, and a part of it is also done by state GST. You would ask me how. Now, RBI is the nodal bank in the country, and foreign trade policy or foreign trade matters concerns themselves with inflow and outflow of money, which is otherwise regulated by RBI, its circulars, FEMA. So therefore, that is why RBI is also involved in the regulation and management of foreign trade policy. Similarly, CBIC, how CBIC? Because various provisions of foreign trade policies are actually affected by notifications under the customs law, notifications under the GST law, like section 16 of the IGST Act, which would allow refund of unutilized ITC to an exporter, or which would allow refund of taxes paid on outward supplies or outward exports to an exporter. These are nothing but provisions in line with foreign trade policy. So that is why we can also say that CBIC, as well as the state GST department, is also in a way engaged in the management of foreign trade or administration of the foreign trade policy. Now, if we are to divide or understand the uh, foreign trade policy in itself, foreign trade policy 2015-20 consists of 9 chapters. Now, out of these 9 chapters, the first and second chapter is basic chapter, which should contain some basic provisions in respect of import and export. Whereas the 9th chapter is for definitions. Usually under taxation laws, you would have second section or second chapter for, not second chapter, but second section for definitions. But under foreign trade policy, it is the 9th chapter wherein you would find various definitions. And first and second chapter is a general chapter, wherein you would find various provisions in relation to import and export. Chapter 3 to chapter 7 is nothing but chapters relating to various schemes under the foreign trade policy, which is nothing but the subject matter of the foreign trade policy series divided into 4 parts by us over 2 weekends. So that is basically our structure for foreign trade policy. Now, like various acts, like various taxation statutes, foreign trade policy, if you consider it to be an act, also has rules to set out certain procedures in respect of provisions given under the foreign trade policy. Those rules under foreign trade policy are not called rules, they are called handbook of procedures, HBP 2015-20, also extended till 31st of March 2021. Now, handbook of procedure is nothing but the rules setting out the procedures of the foreign trade policy issued under or issued in terms of in line with para 1.02 of the foreign trade policy. Now the striking feature of handbook of procedure is same as the case of foreign trade policy where you have 9 chapters is the handbook of procedure wherein also you have 9 chapters. Now each chapter under the handbook of procedure corresponds to the chapter under the foreign trade policy. So the provisions under chapter 3 of the foreign trade policy will have its rules, will have its procedures under chapter 3 of the handbook of procedure. That is how the schema is placed under the foreign trade policy read with the handbook of procedures. Now, like any other taxation statute, this foreign trade policy also, though it is not a taxation statute, but still this foreign trade policy also has some forms attached to it. Those forms usually under GST or maybe customs are just called forms. But under foreign trade policy, they are called Aryat Niryat forms. ANF, Aryat Niryat forms. Aryat is, not Aryat, Ayat Niryat forms. So Ayat is import, Niryat is export. There are also certain appendices, which is nothing but some list of goods, some list of authorities. So some procedural matters only listed out in the manner of appendices. Then a part of foreign trade policy is SION, Standard Input Output Norms. What are these? These are norms which would determine or which would provide for input output ratio of various products that can be manufactured in India. That is, if you would basically go to your customs tariff, you will have 98 chapters, chapter 1 to chapter 98, and goods are divided into these 98 chapters, chapter 1 to chapter 98. Now, this standard input output norms, what does it do? It gives out the basic or the standardized or the general input output norm for the manufacture of most of the product covered under chapter 1 to chapter 98 of a HSN. That is, if suppose there is this mouse and it is 8471, assuming that is the chapter classification, sorry, the HSN classification of this product, then this SION norm will give out the input output ratio for this mouse. So it will tell us that 1 unit of mouse would require 1 rubber pad, 1 mouse wheel, sorry, 2 buttons, this much grammage of plastic, so on and so forth. So standard input output norms is a part of foreign trade policy. What is the use of standard input output norms? You will find its usage while you will discuss chapter 4 duty remission schemes in terms of advance authorization or DFIA. That is where you would find its usage. So we will restrict our discussion to our topic. I've just given you a hint that where would you find the usage of standard input output norms and what do they actually provide. So this is nothing but a list of appendices. I've just given a screenshot just so as to give you a better picture of what we are discussing. This is that list of forms. I've just given a screenshot wherein there is a form for applying for IEC, there is a form for profile for exporter, there is a form for import certificate and various others. Now, also is a part of foreign trade policy is something called ITC-HS. ITC-HS, Indian Trade Classification Harmonized System. This ITC-HS is issued under para 2.02 of the foreign trade policy. First things first, let us not confuse this ITC-HS with the customs schedule that you must have already read or discussed or seen. Customs schedule is a schedule given under the Customs Tariff Act, which lists out those 98 chapter goods with the custom duty rate against those goods. This is not that same thing. It is, or for better understanding, ITC-HS is nothing but 2 schedules providing for all these goods from chapter 1 to chapter 98 and the respective import and export policy of India regarding those goods. So no rate of customs, but policy of India regarding import and export of those goods. Now, why is it called Indian Trade Classification Harmonized System? It is called Harmonized System because India being member of WTO is aligned up till 6-digit level, up till 6-digit level with the Harmonized System of Nomenclature, HSN. So if you would have seen an HSN, that HSN which would be up till 6-digit level. So chapter heading and subheading. So 84, 71, 32, suppose. So that will be the list level of this HSN, 84, 71, 32. So chapter 84, subchapter 71, heading, sorry, chapter 84, heading 71, subheading 32. This would be the alignment of Indian trade classification with the world HSN. So there is a HSN which is adopted by all the WTO members. That HSN has classification up to 6 digit, chapter, chapter heading, chapter subheading. India is also aligned with that HSN up to 6 digit, but India has 8 digit HSN. That is, it has 8 digit classification. So you will also have a 90 suppose. So this is called tariff entry. This is basically called tariff entry after the last 2 digits. Now this ITCHS will give out or will have two schedules, schedule 1 and schedule 2. Schedule 1 is for import policy, schedule 2 is for export policy. Import policy, export policy. Now in this import policy, you will find all these 98 chapters, 98. And against each chapter or against each goods in the chapter, will there be written free or restricted or STE or prohibited? Now this gives out the import policy if given in schedule 1 or export policy if given in schedule 2 of India. So suppose a product is listed as free, means it is free for import if in schedule 1 or free for export if in schedule 2. If it is written as restricted, means it is restricted subject to certain conditions. Those conditions can be obtaining of a license, obtaining of a quota, taking of a permission, something like that. If it is STE, state trading enterprises, means that relevant goods export or import can be done only by a state trading enterprise like DSIDC or maybe some other state trading enterprise, any government owned enterprise. And if it is prohibited, means that relevant goods export or import cannot be done if the export policy is prohibited. So this particular document called ITCHS aligned till 6 digit level having 8 digit as the classification is also a part of foreign trade policy. It is issued under para 2.02 of the foreign trade policy. You must have seen notifications where you would have read that export of onions is barred. Export of potatoes is barred to Pakistan. How do they do it? They do it by amending this ITCHS, wherein they would mention prohibited in front of onions when exported to Pakistan. So that is the way they would manage Indian export and import in terms of policy. Then in addition to Handbook of Procedure, ITCHS and SEIS norms, foreign trade policy also consists of something called public notices. Public notices are issued under powers given under para 2.04 of the foreign trade policy. These public notices, though word is public notices, but are nothing but documents for specifying procedures for implementation of foreign trade policy. So public notices are nothing but documents wherein certain procedures will be given out for implementation of various provisions of foreign trade policy. So the document used would be public notice. It will be termed as public notice. There are also notifications issued under foreign trade policy in order to amend the policy. Quite simple. We all know. So in order to amend the policy, there will be notification. There are also two more type of documents issued under foreign trade policy, and those are trade notices and circulars. Circular, as the name suggests, are nothing but documents for clarification on various matters under the foreign trade policy or the handbook of procedures. And trade notices are also used for basically the same thing, for ensuring that there are uniform application of the procedure and provisions of the foreign trade policy and the handbook of procedures. So in terms of documents that you would see under foreign trade policy, you will have a foreign trade policy, which is nothing like an act, which is like an act. Then you will have a handbook of procedures, which is like a rule. Then you will have something called SEIS norms, which will be used for a certain scheme under the policy. Then you will have ITCHS, which is nothing but our import and export policy. That is whether the import or export is free, restricted, prohibited, or regulated by only state trading enterprises. Then you will have notifications to amend this policy. You will have public notices to give out certain implementational rules. You will have trade notices, and you will have circulars for certain clarifications. That is the basic structure of foreign trade policy. So as I told you, foreign trade policy is divided into 9 chapters, and these are these chapters. Today we are going to basically cover chapter 3. I have given you a hint of chapter 1 and 2, not covered it as a whole because it's a huge chapter, maybe relevant to you, maybe not relevant to you, cannot be covered in a session of 1.52 hours. So I have taken few points from 1 and 2, and we will be discussing in detail chapter 3. Then you have chapter 4 as advance authorization and DFIA. Chapter 5 is EPCG. Chapter 6 is all EOUs and related type of statuses. Chapter 7 is deemed exports. Chapter 8 is for quality complaints, and chapter 9 is for definitions. Now, having discussed the foreign trade policy in terms of its basic structure and framework and regulation and administration, let us now proceed to the actual scheme that we are to discuss today. And that scheme is called the scheme of SEIS and MEIS. Now, before I move on to the scheme, I want to bifurcate or create a structure in your mind in terms of the schemes offered under foreign trade policy. So basically the schemes or the rewards under foreign trade policy can be divided into 3 basic categories. The categories are, there are some pre-export incentives, then there are certain post-export incentives, and then there are schemes which are status-based. When I say pre-export means this benefit is taken before even you export goods or services outside India. So basically foreign trade policy obviously will give you benefit or reward for doing or for making exports out of India. But this benefit, which is under the category of pre-export incentives, would be given even before you export, obviously with an obligation to export, but even before you export. Post-export is when you have actually exported and show the proof of export and realization is what is when you will get the benefit or the incentive. And some are status-based incentives. That is, you obviously you have to make exports under this also, but these are status-based. These are not directly correlated with your value of exports. So once you show that you are an export performer, you get a status, and based on that status, you get some rewards, benefits, facilitations. That is how it works. So today we will be discussing post-export benefits. Under post-export benefits, there are 3 types of benefits. The first one being duty drawback. Now, duty drawback in terms of benefits, though mentioned under the foreign trade policy, finds its provisions under the customs law, section 74 and 75 of the Customs Act. So we will not be going to discuss duty drawback as such. Our discussion would be restricted to 2 schemes, and those schemes are called Merchandise Exports from India scheme, that is MEIS, and Services Export from India scheme, that is called SEIS. That is our point of discussion today. We will first start with Merchandise Export from India scheme. Now let us see what is the scheme all about. Now this scheme is basically given, or this scheme is basically formulated in order to promote goods, or in order to promote export of goods which are manufactured in India. So 2 things are important. There should be export and there should be a manufacture of goods in India. That is what they want to promote under the scheme. Now the question comes, why would you want to promote this? And why would you want to promote this by way of a benefit? Because if somebody manufactures and sells domestically, he does not get it. But if somebody manufactures and exports, he gets it. So what is the reason behind it? They say, or the policy says, that MEIS is granted, or MEIS reward is granted in order to countervail, in order to offset the infrastructural efficiencies associated with exports. So government of India recognizes and acknowledges that India has some infrastructure inefficiencies, which leads to higher costs for exporters. And therefore, our foreign trade policy should offset these higher costs to the exporters by way of a reward. So the basic premise of giving out MEIS or formulating MEIS is to offset infrastructural inefficiencies that are present in India. Now the question comes, who would be eligible for MEIS? MEIS would be available on all notified goods as per the classification given under ITCHS when sold to notified markets. Now you would ask me, where are these goods listed? Where are these markets listed? As I told you, part of foreign trade policy is appendixes and Aryat Niryat forms. So the eligibility or eligible goods under MEIS are listed under Appendix 3B. Appendix 3B to the foreign trade policy is where these notified products are notified along with the rate of MEIS. Then you would ask me, how will I get this benefit, or what will I get in terms of benefit? Will I get cash? Will I get check? Will I get some duty exemption? What will I get? The person who would be eligible for this will get duty credit scripts, nothing but a document which would entitle that person who has got these scripts to use the document against payment of certain duties. The only or the striking feature of this script is that this script is a holder document. Not a holder document, but a negotiable document, not a holder document, but a negotiable document. That meaning thereby that is, suppose I made the export and I got these duty reward scripts, and if it is nothing but a paper, that paper can be endorsed to somebody else also. So it is freely transferable and saleable in the market. And obviously, as I told you, these scripts or this paper can be used for payment of certain duties. So obviously, if the script value is 100 and I am wanting to, or I am willing to sell it at 98, the other person would be willing to buy from me. Why? Because he would purchase that paper from me for 98 and use it for making payment of duty worth rupees 100 and save 2 rupees. So that is the USP of this scheme. Duty credit scripts which are transferable. So as I told you, that the rate of MEIS, that is the reward calculation of MEIS, is mentioned in the Appendix 3B of Foreign Trade Policy. And this is that 3B appendix, and this is the sample of the goods mentioned there and the rate. So we'll take one like we can take fresh water. So fresh water ITCHS is so and so, and the MEIS rate is 7%. MEIS rate is 7%. So 7% is the rate of which you will be given duty reward scripts, which can be sold by you in the market for a rate lower than the value of the script, or it can even be used by you for payment of certain duties while you import goods. Otherwise, any goods not related to the script, not related to what you do, something else also, you can use that. Now, one point to note here is that though the FTP provides that MEIS rewards will be based on the rates given in Appendix 3B when goods are exported to certain notified markets. But of late, this classification of market has been done away with. Though markets are mentioned here in the appendix, but if you read the relevant public notice, you would find that earlier the MEIS rate used to be dependent upon the country group that you are exporting the goods to. So if you are exporting to country group A, MEIS group rate would be something else. Country group B, it would be something else. But that has been done away with. Now, wherever you export, the rate of MEIS will be same. Earlier, it was based on the classification of rate was based on the country group, various country groups. So basically, China would be at a lower rate group, and maybe European countries would be at a higher rate group, and that is how. Now, you would ask me that if 7% is mentioned against a particular type of good, then how do I calculate this reward eligible to me? I would calculate this reward by multiplying that rate to the FOB value, free on board value of exports in free foreign exchange. That is my reward scheme. So suppose my rate is 7% and I exported goods worth rupees $1,000, then my eligibility is 7% of $1,000. That is the value of scrip that I will receive from DGFT department, and which can be sold for any value lesser than the value of the scripts. Now, one point to note is that this reward scheme is based on realization. That is, while calculating this percentage, you have to take the realized FOB value or the FOB value, whichever is lower. That is, so effectively what they are saying is, they are saying you will get this reward only if you have realized the money. Mere export of goods would not qualify you or make you eligible for the reward. You will have to also realize the money, then only will you get this reward. Now, what all types of exports are covered? In order to understand this, we must understand what are all the modes of export. You can export by sea, you can export by air, you can export by courier, you can export by post, you can export by baggage. Once you take goods outside the country, a foreign visitor or a foreign citizen taking goods from India to outside country. So there are various modes of export. What all are the modes which are covered? Exports by sea is covered. Exports by air cargo, that is air, is covered. Exports by rail is covered. Exports by road is covered. But export by courier or post is covered only in respect of goods notified in Appendix 3C, and that too up to a FOB value of 5 lakh per consignment. That is the limitation for qualification of MEIS on exports by post, and this is Appendix 3C. The notification of rate was Appendix 3B. This is Appendix 3C, which will list out the goods which will be eligible for MEIS even when exported by courier or foreign post office. What are the goods? The goods are as mentioned: handicraft items, handloom products, books, leather footwear. Only if these goods are sold on e-commerce platform, then only will MEIS be eligible on these goods. So MEIS will be eligible if goods are sold on e-commerce platform, and only these notified goods through courier or foreign post office, that too up to a upper limit of 5 lakh per consignment. So if your consignment is 7 lakh worth, then you will get MEIS 7%. Suppose 7% is the rate, only 7% on 5 lakh. Though maybe your consignment value is 7 lakh and you have realized 7 lakhs, but your MEIS is restricted to 5 lakh rupees. Now, another very important question is, you would ask me, whether do I have to be a manufacturer to be eligible for MEIS? Only if I manufacture, if I have a factory of my own and I export, then I have to be eligible, then I can be eligible for MEIS? No. The condition is the good should be manufactured in India. It should not be an import and re-export case. That should not be the case. But you can be even a trader, a merchant, exporter, a supporting manufacturer too, in order to be eligible for MEIS. The only thing is, you should certify that the goods belong to India. The certificate of origin or the goods have origin in India. It is not a case of import and re-export. You need not be the actual manufacturer of good in order to claim MEIS. One more provision is there in terms of MEIS is that suppose I have made exports of goods and I have a particular IEC and IEC is PAN based, then if I don't want to claim MEIS, I can't transfer my export performance to anybody else, any other IEC holder. So the person who has realized the foreign exchange and who has actually made the export, whose name is written in the shipping bill, is the person who is eligible for MEIS scheme and the MEIS reward, except in the case of supporting manufacturer, wherein a different scenario can be there. But except for that, you can't transfer your export performance to anybody else and have that person claim MEIS. So if merchant exporters are eligible for MEIS, manufacturers are eligible for MEIS. Who are not eligible for MEIS? What is the negative list for MEIS? Supplies made from DTA to SEZ units. What is it? In general terminology, or as per the FTP also, it is called deemed exports. So if you do not actually physically export the goods out of India, but only give it to an SEZ unit, that type of export or that type of supply is not covered for MEIS. So if you supply to SEZ, you may be getting zero rated under Section 16 of IGST Act. You may also be getting various other foreign trade policy schemes, but you will not get MEIS. That is one ineligible uh, criteria for ineligibility criteria for MEIS. The second one is all other types of deemed exports, like supply to export oriented undertakings, supply of capital goods to a EPCG holder, supply of normal goods or input goods to a advance authorization holder. All these are negative listed. Now you would ask me, who is an EPCG holder, who is an advance authorization holder? Now that itself is a long discussion and part of the ensuing seminars. What you can remember for now is that any type of export other than physical export out of India is not covered under MEIS. Then they say export through transshipment will also not be covered under MEIS. Obviously, because the basic feature is that the goods should be manufactured in India. If it is only transshipping in India, goods come from other country, reach the shores, not even get cleared in India and are sent to other country, that type of goods will obviously not be eligible for MEIS. Exports made by FTWZ, foreign trade warehousing zones. What are these? These are actually zones wherein you can import goods and resell them to other foreign markets. Basically, the case of transshipment. So obviously, because these goods are also not manufactured in India, not eligible for MEIS. Exports done by EOUs, electronic hardware technology parks, biotechnology parks, software technology parks, will also not be eligible for MEIS. I'm not saying supply to them. I'm saying if there is an export oriented undertaking and making supplies or exports outside India, those export also will not be eligible for MEIS. SEZ, EOU, EHTP, BTP, F2WZ, products exported through DTA units, that also will not be eligible for MEIS. Products which are subject to export price or export duty. Obviously, MEIS is given in order to promote export, to offset infrastructure inefficiencies that India has. But if there are certain goods which are restricted in terms of export policy or which are liable to export duty, which is a very minimal list. So if something is otherwise restricted for export, restricted subject to certain permissions, or if it is subject to export duty, that means it is not the intent of India to promote its export. And obviously, if it is not the intent so, then why should there be a MEIS reward also given on that kind of export? And therefore, logically, this is also excluded from the eligibility of MEIS. Then there are certain listed goods which are not eligible for MEIS. And that list is here. You can refer to the list. There are cereals, oats, and concentrates, and various others. You can refer to that list, and so it is understandable by reading only. It's just a list. Now the question comes, suppose I have exported goods and these exports were eligible for MEIS and I have applied for MEIS and I've got this MEIS in terms of duty credit scrips. I got these scrips. What do I do with these scrips? As I told you, it can be sold in the market. But why would someone buy it? Someone would buy it, or you would also keep it, because they can be used. They can be used for payment of duty. What all types of duty? Basically, it is used for payment of BCD, basic customs duty. So suppose I have got a script of rupees 100, of value worth rupees 100. I can use that script to pay BCD on any type of import, except for some exceptions, while I make the import of those goods. So instead of paying cash, I can make payment through usage of these scripts. And that is why these scripts are saleable, because there are many importers all throughout India, and they want these scripts so that they can even save on the duty that is payable by them in terms of basic customs duty. What all are the other things on which or against which these reward scripts can be used? These can be used for payment of any composition fee or an application fee under the FTP. These can also be used for making up for the default in export obligation. Now, this concept may be new to you because you have not gone to those schemes, and those are part of ensuing seminars. You have to remember this for now and correlate at the time when they are discussed. So if there is a default by a person under the foreign trade policy, and those are called export obligation defaults, then you have to make payment of some custom duties, and that is then also you can use the reward scripts. Basically, what you have to remember and understand this, that this duty is basically used for payment of BCD. So instead of cash, you can use these scripts. What you cannot use it for is payment of IGST on imports, payment of compensation cess on imports. That is not payable through these duty credit scripts. Another very important point while we discuss usage of the scripts is that if you suppose this is a script that you've got and it is value worth 100, when you sell the script, it is nothing but supply of goods. So these scripts which are transferable and having value is nothing but supply of goods. Being supply of goods, they must be liable to GST, but howsoever they are liable to GST at nil rate. At nil rate. So whenever you sell this script, suppose you are a manufacturer or you are a merchant trader who has got MEIS scripts and you sell them, these scripts are liable to nil rate of GST. Now, another point in terms of MEIS that should be communicated and should be understood by you is that suppose you pay basic customs duty using this script, you will still be eligible for duty drawback on the basic customs duty. So I'll just give you an example to make you understand this. So suppose this is outside India and this is India, and you have imported certain goods, and the assessable value for import is 100, and BCD on these goods is 10%, that is 10 rupees. So you paid you paid this 10 rupees using the script. Now you exported these goods back to some other country. When you made payment of this 10 rupees using an MEIS script, your MEIS script got used. Now, as per section 74 of the Customs Act, if a person imports certain goods and then exports thereon without using the goods, he is eligible for 98% refund of, 98% refund of BCD paid at the time of it. So what have I done? I have imported certain goods and exported them. So effectively, those goods are not used in India. So therefore, customs says whatever basic custom duty that you have paid, we will give 98% back to you. And that refund is called drawback. Now, some may have doubts that if I have not paid this BCD at the time of import by way of payment in cash, and I have paid this duty by way of usage of scripts, will I be eligible for this drawback? The law clarifies that yes, you will be eligible for drawback. So payment of BCD by way of duty credit script is at par with payment of duty with cash. Now we come to procedures. We have understood the scheme. Now we come to procedures. How do you file for MEIS? Once you have made the export and you have realized the foreign exchange, how do you apply for this script or how do you apply for this scheme? The process is online on the DGFT website, wherein you have to fill a form called ANF, Ayat Niryat Form 3A, Ayat Niryat Form 3D, depending upon the type of export you do. You export through courier or foreign post office, through e-commerce, or you do it otherwise. Now the question comes, suppose I am an exporter of goods and I export goods to various countries. And I have exports from Chennai also, from Nhava Sheva, Maharashtra also, from JNPT also, from Mundra, Gujarat also. So various ports is what I use. And I have offices in various states. So how do I apply for this MEIS? Which office of the DGFT should I go to? Because as I told you, there is a headquarter in Delhi and there are various regional offices all over India. They say that applicant shall have the option to choose the jurisdictional RA on the basis of corporate office, registered office, head office, branch office. In simple words, wherever you have an office in India, you can choose that location's RA for applying for MEIS for the complete India. And once you have chosen that RA, you that RA will remain your RA for all MEIS applications for the complete year. And that choice is to be made at the beginning of the financial year. So it is not that if you are making exports from 100 from 10 locations, you will apply for MEIS with different RAs or before different RAs. You can have one RA based on the premise, business premise, whichever premise. Choose one, apply it for the complete financial year. Now, suppose a person has unit in a DTA, domestic tariff area, or a unit in terms of an ESTP, BTP, or STP. And it has units more than one. Then who would be jurisdictional RA? As I told you, whichever you have chosen. As per your registered office, corporate office, branch, whichever office, whichever you have chosen is your RA. Suppose there is a person who has unit in SEZ or UU or both. So he does not have a unit in DTA, he has a unit in SEZ, UU or both. Then who would be your relevant RA? Now to understand this, you have to understand the administration of SEZ. SEZs are administered through SEZ development commissioners who are nothing but customs officers. Customs officers come under the Ministry of Finance. And these officers, that is RA officers or DGFT officers, come under the Ministry of Commerce. So because SEZ is regulated by because SEZs are regulated by development commissioners who come under the Ministry of Finance. And if there is a person who has units in SEZ or UU or both, then he has to choose his respective development commissioner in SEZ. He will not apply to DGFT department. He will apply to development commissioner, who is a customs official who regulates SEZs. Now, suppose there is a person who has units in DTA also and SEZ also. So I have a unit in SEZ Chennai and I have a unit in DTA, Maharashtra also, Haryana also, and various others. Then what do I do? Because a part of my export is regulated by a development commissioner who is a customs official, and a part of my export is regulated by these normal RAs, which is a DGFT department. So they say apply respectively. For SEZ, you go to development commissioner. For the rest of the DTA units, you go to the respective RA, whichever you have chosen for the financial year. One RA, whichever you have chosen for the financial year. So that is how you decide upon the jurisdiction of the MEIS application. And that is very, very relevant. Why? Because it is difficult. I'm just telling you a general understanding. You can't take my words for it, and there is no straightjacket answer for it. But generally, you would find it is difficult to get an application processed of MEIS through a development commissioner comparative to a RA officer or to a DGFT officer, because DGFT officer deals with them day in, day out. Commissioners have many more things to do other than these foreign trade policy matters only. Now, once you get this script is subject to a registration. So you have to get this script registered at a port, and then only can you use it for payment of BCD, as I told you. Now, suppose you make exports through EDI port. EDI ports are ports which are electronically enabled, where electronic data interchange happens, which are not manually operated. So if all your exports are through EDI ports, suppose JNPT is EDI port, Mudra is EDI port, Nawashipi is EDI port, I'm just assuming. So then you can get your script registered at any one of the EDI ports. And wherever it will be registered, it can be used, this script can be used for payment of duty at any EDI port. So it may be registered at JNPT, but it can be used at any other EDI port also. For shipments that you make from a non-EDI port, you have to get the script registered at that non-EDI port only. So if through an EDI port, you can choose one EDI port and get it registered. If the exports are made through non-EDI port, script has to be registered at that non-EDI port only. And it will be used at that non-EDI port only, subject to a transfer procedure, or except in the case of a transfer procedure. So as I told you, if you are exporting through a EDI port or through many EDI ports, you get your script registered at one EDI port. You can use this script for payment of duty at any EDI port. But if suppose you want this script after you have attained the script, so you export it through EDI ports, electronically enabled ports, you got a script, you registered at one EDI port, suppose Delhi. Then after you have got the script and you registered it, you realize that I am going to import at a non-EDI port. What do I do? Because I can use this script only at a EDI port. I registered at a EDI port. Then you have to follow a transfer process called a TRA, transfer release process. Suppose you have exported through a non-EDI port, you will have to get registered the script at that TRA port. And if you want to use that script for payment of duty at any other port other than that non-EDI port, you have to follow a TRA process. That is a transfer process. Suppose you exported through a SEZ port, then you have to register it at that very SEZ port only. And if you want to use the script at any other port, then you have to follow a TRA process. So the flexibility is only in case of a EDI port. There is no flexibility in case of a non-EDI or a SEZ port. Now, with effect from 10th of April 2019, that transfer facility of script registered at the EDI port to be used at a non-EDI port has been stopped. So with effect from 10th April 2019, there can be no transfer of scripts which are registered at a EDI port to any other non-EDI port. It cannot happen. That has been stopped. However, there is still the process of transfer of scripts from one non-EDI or SEZ port to another non-EDI SEZ port is available. Then how do you file for the MEIS reward scheme? They say you can file an application for rewards under MEIS by clubbing at the max 50 shipping bills. So it is not that you have clubbed all the 1,000 of shipping bills that you have filed all throughout the year and filed one application. One application can at max have 50 shipping bills. And shipping bill is the relevant document for claiming MEIS, obviously, because it is on export of goods. So only 50 shipping bills can be clubbed in one Ayat Niryat form 3A or 3B. Suppose you make export from any EDI port, then you can make application and club shipments of all EDI ports. in one application. But suppose you make shipment from 2 or more non-EDI ports, then you have to file separate application for each non-EDI port. How do you do it? At the time of filing the shipping bill, in case of a EDI port, you have to checkbox a box, yes, in reward column, and basically declare that I will be claiming MEIS on these goods. In a non-EDI port wherein you will file a manual shipping bill, which is not electronically enabled, you will make a declaration at the time of export itself. We intend to claim rewards under the MEIS scheme. So that is the process. Now, what is the procedure for processing of these applications? Basically, these will go to the relevant RA or the development commissioner. And these RAs or development commissioner will scrutinize the application in terms of shipping bills, realization, and proof of landing. So the application should always be suffixed with, complemented with proof of landing. So not just realization, but proof of landing is also relevant for claiming the MEIS reward. Proof of landing is nothing but a proof that the goods have actually reached the foreign shores. That is also important for processing of an MEIS application. So these are nothing but list of documents which can be taken as proof of landing, which you can go through and analyze for yourself. Now, suppose I am applying for a MEIS application. So I made an export. While making the export, I made the declaration. Suppose I am exporting from a non-EDI port. I made the declaration. I am exporting through a EDI port. I have ticked the checkbox, and this export has happened. I have realized the foreign currency, and I have filed the form also for MEIS reward. My script value comes out to rupees 97 lakhs. Suppose. Then how many scripts will I get? Will I get only one script of 97 lakhs? Why is this important? Because if I get only one script of 97 lakhs, I will have to find a customer who is willing to buy a script worth rupees 97 lakhs. And then only will I be able to sell the script. So the law allows me to split the script value in multiples of 5 lakh each. So if I am claiming for 97, I can have scripts of 5, 5, 5 each, 10, 10, 10 each, 15, 15, 15 each, and the last one will be the residual value. So suppose I am applying for 12, I can have 2, 5, and 1, 2 lakh script. It can be multiples of 5. It can be 10, 10, 10, 15, 15, 15, 20, 20, 20, whatever. But in multiples of 5, any residual value, 5 lakhs, any residual value will be the last script. Now, in case of an EDI port, if you would have applied for no split at the time of application, you can at a post facto also, get these scripts splitted even after you have received the script. But if you have supplied from a non-EDI port, this facility of post facto splitting is not available. Now, what is the validity? So once you have got script, up till what time can you use it for payment of BCD? You can use it from payment of BCD for 24 months from the date of issue. One important factor or point is revalidation is not allowed. You cannot revalidate or you cannot get this script revalidated. Once it has expired, 24 months have expired, they have expired. Now, what is the time limit for filing application under MEIS? The time limit is 12 months from the let export order date, or 3 months from the date of uploading of shipping bills onto the DGFT server by customs, or in case of non-EDI port, release of shipping bills, whichever is later. So basically 12 months from the let export date. In simpler words, 12 months from the let export date, you have to file for an MEIS application. Now, these two pointers are nothing but reliefs given on account of COVID-19. So they have said that for shipping bills where the let export order date falls during 1st February 19 to 31st May 2019, application may be filed within 15 months instead of 12 months. What are they doing? They are saying if your let export order date was 1st February 2019, your last date was 31st of January or 1st of February 2020, during which time COVID had come in. So you will give you 3 months extra. Suppose your late export order date was 31st of May 19, then your last date was 31st of May 20. We will give you 3 months extra. Second pointer is regarding late cut. Now first understand late cut. They say you have to file this application within 12 months, but you can also file this application beyond 12 months with a late cut. So over the first 6 months of delay, so suppose your date for late export order was 1st Jan 2017, then 12 months expire on 1st Jan 2018. Up till this time you can file. You can file till 1st July 2018 with a late cut of 2%. This 2% will be 2% of the MEIS script value. So suppose your script, your MEIS rate is 7% and you have exported for 100 or suppose 1000. So 7% your MEIS script value is 70. On this 70 rupees, you will not get 70, but you will get 98% of this 70. Similarly, if you apply beyond 6 months delay, that is a delay from 6 months extra till 12 months, then your late cut would be 5%. It is not 2 plus 5, but 5 only. And if you apply 12 months after the due date, but up to 2 years after the due date, late cut is 10%, not 5 plus 10 or 2 plus 5 plus 10, but 10. So basically the last date, even with late cut to file MEIS is 3 years from the let export order. Now another pointer which is very relevant is supplementary claims are not allowed. That is, suppose if you miss out certain shipping bills while filing for this claim, you cannot file a supplementary claim for the same period. You have to be very sure while you are filing the claim. And the last point for MEIS is that there is also a risk management system wherein if suppose you have filed an MEIS scheme application and at the time of filing you represented what you had to represent and you misrepresented also maybe, and you still got the scripts, there is a scenario where your scripts will be checked, your application will be checked, and if found that you have taken it fraudulently, misrepresentedly, something like that, this script amount will be taken back from you in cash along with interest. However, if you have not sold the script and you have not utilized also the script and scripts are lying with you and the officer says the scripts issued to you are incorrect and therefore recoverable, in those cases, instead of paying the interest, you can surrender the script itself. So this was basically merchandise export from India scheme, which is nothing but a duty reward scheme for export of goods outside India. Now, one point to be noted here is that this merchandise export from India scheme is being discontinued from 1st of January 2021. Why? We will understand the reason in the last part of this seminar of this session, wherein we will discuss the WTO dispute and RoDTEP scheme. For now, we are discussing the next scheme called the SEIS, which is nothing but a corresponding scheme for services. Corresponding to MEIS is a SEIS scheme that was for goods. This one is for services. Again, the motive or the intention or the objective is to encourage exports. The reason for it is again the same, infrastructural inefficiencies in India for exporters, and that is why they want to offset that. The eligibility is a percentage of notified services given in a notification, and that notification or the notified services are in appendix 3D and 3E. For goods it was 3B. For services it is 3D and 3E. Again, in this scheme also you get a duty credit scheme, which is freely transferable. Same scheme, just for services with some changes that we will discuss. Now, all types of services exported are not eligible for SEIS. So, like as I told you that for SEIS only notified services are eligible. Some notified services are given in this screenshot, like legal services, like accounting services, like taxation services. So suppose you have a KPO, knowledge processing outsourcing center, or LPO, legal processing outsourcing center in India, and you are exporting legal services outside India. Then on the export value that you realize in India, you will get duty credit scripts worth 7% or 5% from DGFT department. That is the kind of benefit that they are giving you. Now, all types of services listed here in this appendix 3D are not eligible for SEIS. Those services should also conform to certain condition, and the condition is that those services should be mode 1 services or mode 2 services. What are mode 1 services? Mode 1 services are services which are performed or which are provided to persons outside India while sitting in India. So your establishment is in India, you are naturally as a person in India, and you are providing to somebody outside India. That is mode 1 services. These are eligible services. Second is consumption abroad. That is, if you provide certain services to a person outside India, but that person has traveled to India to receive that services. So suppose there is a person who has come to India, he receives the services, given you foreign exchange. That service is also, this mode of service is also covered under SEIS. There is a third mode. The third mode is, suppose for providing services outside India, you establish a commercial establishment itself outside India. So you have an establishment in India, but in order to provide that service, suppose the service is construction monitoring or installation of an equipment, you establish an establishment outside India. Now, though you are exporting service outside India and you are getting foreign exchange, and though your service is a notified service, but you will still not get SEIS. Why? Because you are mode 3, and mode 3 is not covered under SEIS. What is the fourth mode? If you provide services by traveling to outside India. So suppose I am to provide a face-to-face training in Hong Kong. I go to Hong Kong, give a face-to-face training, receive foreign exchange, come back. I am exporting. Training is a notified service. There is a percentage also, but I will not get because it is mode 4. So there are 4 modes of services, out of which only 2 modes, that is services provided sitting in India to a person outside India, or services provided sitting in India to a person who has traveled from outside India to India, are covered. Services provided by way of opening an establishment outside India, not covered. Services provided by way of traveling outside India, not covered. Now, there is also a minimum eligibility criteria for somebody to be eligible under SEIS. That eligibility criteria is that if you are an individual or a sole proprietor, you should have made an export of at least $10,000 in the year of rendering service. So suppose I am to apply SEIS scheme for 2019-20. I should have made at least an export of $10,000 for being able to, or for being eligible under SEIS scheme. For forms of organization other than sole proprietorship and individual, it is $15,000 in the year of rendering service. Now, the basic criteria for getting SEIS is that there should be export of services and you should have realized foreign currency. And those services are listed in Appendix 3D, and those listed services will be eligible for SEIS. There is also one more appendix called Appendix 3E, wherein certain services as listed in Appendix 3, even when provided to foreign agents in India and receiving foreign, not foreign currency, but INR against those services. So suppose even when I provide services to foreign agents in India and they don't give me foreign convertible exchange, but give me INR, still I will be eligible for SEIS scheme. But my service should be listed in Appendix 3. Let us see Appendix 3. These are the type of services. I have just given you a one screenshot. There are many more. What are these services? Let us understand this. I'll give you an example and maybe try to explain. Suppose there is a shipping line based out of US. Now this shipping line usually has agency office, and these are separate companies only, not agency office as per RBI, but these have some agency companies in India. So suppose it is MERS and it has subsidiaries in India who are nothing but agents to this foreign company. Now they take orders for all shipping in India. For doing the shipping from India to any other country, they would need certain services such as cargo handling, such as pushing and towing, maintenance of vehicle, all these type of services they would need from Indian vendors. Now, basically, these Indian vendors are providing services to foreign shipping line. But because these foreign shipping lines have agency companies in India, rather than paying foreign exchange, they pay through INR, they pay INR through their agency companies in India. Those type of services wherein otherwise you would have received foreign exchange, but for these companies being in India, you have received INR. Those type of services as listed in Appendix 3 are also eligible for SEIS. So that is the only exception wherein even in case of an INR receipt, you will get an SEIS script. Now the next thing is, how do you calculate this SEIS script amount? The formula is, what was the formula in goods? It was FOB value of goods into rate. Simple. Here the formula is net foreign exchange, that is foreign currency earned minus foreign currency earned minus foreign expenses. Whatever will be the value, multiply by rate. This is the formula. So formula is whatever you have earned, that is whatever you have received in terms of foreign currency during the year in respect of services provided during the year, minus whatever expenses that you have made in order to provide those services, foreign expenses, not all expenses, foreign expenses. The balance of the two multiplied by the rate is the SEIS reward amount. Now, if suppose a person is doing more than one service, doing manufacturing as well as service, then you have to categorize your income and expenses as per the sector that you are applying for. You don't have to club them. Now, this is very, very relevant. What are all the services or what are all the categories which are ineligible for SEIS? Suppose you are receiving foreign exchange on account of debt participation. So any type of capital inflow, not for any services, not eligible, obviously. Suppose you are getting foreign currency on account of foreign employment in an employer-employee relationship. Though you may be providing any type of service listed on that Appendix 3D, but you are actually not providing that service. It is not a contract for service, it is a contract of service. So therefore, that type of foreign exchange earned out of an employment contract is not covered. As I told you, mode 3 and mode 4 is not covered. What is not covered? Suppose you get money from an EFC account. What is an EFC account? EFC accounts are accounts which are allowed to be opened by domestic players in order to prevent their foreign currency to be converted, because every time you receive foreign currency, you have to convert them, and there is a exchange loss also, and there is a commission also involved. So you can maintain a EFC account and maintain foreign currency in that. So if you have received money not in proper foreign currency but through an EFC account, no SEIS for you. Suppose you have, so for units which are EOU, ESTP, STP, BTP. So if there is an EOU unit supplying services outside India, this will not be eligible for SEIS. Huge. This is very, very impactful. That is why many units exit from EOU scheme, because SEIS is such a huge benefit, 7%, 5% of the basically the turnover. Services in telecom sector. So basically services provided by Bharti Airtel or Vodafone Idea or Tata Communications, these kind of services are not eligible for SEIS. Services or foreign exchange earnings provided by airlines and shipping lines, wherein that shipping line is providing service from one foreign country to another, but receiving foreign currency in India because it has an office in India, it has taking bookings in India. That type of service is also not covered, because obviously the reason for giving this scheme is, this reward is infrastructure inefficiency. That shipping line has done nothing in India, has not faced infrastructural deficiencies in India, and therefore it should not be given this benefit. One another major point for ineligibility under SEIS is that you should have an IEC at the time of rendering the service. This is one big problem. Basically, if I'm a service provider and I'm to provide services outside India, I don't need an IEC otherwise. Except for this condition, I don't need an IEC. If I want to provide chartered accountant services to a person outside India, I don't need an IEC. But this scheme says that if you did not have an IEC when you provided the service, then no SEIS. Now, this specific provision has been challenged before the Delhi High Court in a decision or in a matter of data flow. But the decision is still due and there is no interim relief granted in this matter. So basically, as of now, if you today apply for an SEIS, wherein for a person who did not have an IC at the time of rendering the service, not at the time of application, but at the time of rendering the service, you will not get the SEIS.
Sorry,
But
Ji,
yes, sir.
just a small question.
Yes,
Sheetal Jain is asking why telecom services are excluded in SEIS benefit.
yes. So Sheetalji, telecom sector is excluded in SEIS because, long story short, I can tell you is, you must have heard of IUC charges, interconnect usage charges. So telecom companies earn a lot of foreign exchange in terms of ISD calls from India to outside India, and those foreign exchanges or those money inflows are huge. So government as a sector has disallowed this SEIS because they can't afford to give you 5 and 7% of those kind of turnovers. So those turnovers are huge, and therefore they are excluded from SEIS scheme. So I was on IEC. So IEC, though not mandatory for providing or export of services, but is a mandate for SEIS in the year of rendering the service. So what I want to give you as an input is that if you are applying for SEIS for a client and that SEIS gets rejected, or you get to know that he did not have an SEIS, he did not have an IEC at the time of rendering the service, don't don't be don't be afraid of filing it. Go ahead and file it, get it rejected. Go to the High Court, get your matter tagged. Maybe you will get a relief. And these are huge reliefs, these are huge benefits. So don't pre-decide yourself, prejudge yourself, and don't apply for it. Apply for it. There is a matter already pending before the Delhi High Court. You may have your other jurisdictional High Court. You may apply it there. And maybe wait for a positive, favorable decision. And there are certain grounds on which this can be taken up. Now, usage of reward slips, same as MEIS for payment of BCD, composition fee, application fee, same. Whether can you use it for IGST or SES? No, you can't use it. Same as MEIS. Drawback, whether duty paid through these slips will be eligible for drawback. Yes, same as MEIS. It will be eligible. How do you file the application? The application form is ANF 3B, Ayat Niryat form 3B. Application is not filed as per 50 shipping bills. This time it is filed per financial year. You will have to file one application for one financial year. What is your jurisdictional RA? You have to decide again the same thing. Jurisdictional RA, one jurisdictional RA based on the premises or based on your business premises for the complete financial year. It can be your branch office, head office, corporate office, sales office, whatever office. But one RA for complete turnover all throughout India. Suppose you are an IC holder in DTA unit only, then you decide your RA based on that office location, whichever RA you want to select. Suppose you are a unit in SEZ and only in SEZ, then you have to go to the respective development commissioner, because obviously you are controlled by a custom officer who is a development commissioner. Suppose you have IC in multiple SEZs, then you can apply your application or give out your application, submit your application to one development commissioner of the SEZ, which has the highest foreign exchange earning. Suppose you have an IC or you have a person who has unit in SEZ as well as DTA. Then single application for all different units to jurisdictional area of DGFT. That is, you don't have to go to development commissioner, but you can go to the normal RA, even for SEZ units. Even for SEZ units. Sometimes it may so happen that you have an SEZ, you have a DTA, you are making exports only through SEZ, but you don't want to apply to the SEZ development commissioner. What you will do, you will make a small export from DTA, go to column number 4, row number 4, and go to RA then, not go to development commissioner. There is a play involved here. You can plan here. Many people do that. Port of registration. You can choose any port of registration, but you have to mention that port of registration at the time of application. Again, that same process. If you want to use it at the same port, you can use it at the same port. But if you want to use it at different port, you have to follow a process of TRA. And that TRA facility from EDI to a non-EDI port is stopped now from 10th of April 2019. Split script, same split, 5 lakhs and multiples thereof. You can apply. Same thing as MEIS. Timing for application, limitation for application. You have to file this application within 12 months from the end of financial year. In that it was 12 months of the let export order date. Here it is 12 months from the end of financial year. Then there are certain relaxations that are given under SEIS due to COVID-19. You can refer to these relaxations. Basically, for applications 2000 for the year 2018-19, the last date now is 31st of December without late cut. So I'll go to late cut first. So the basic time limit is 1 year from the end of financial year. But if you apply after 1 year, so this is 1 year. If you apply 1 year but up to 6 months, then 2% late cut. If you apply after 6 months, another 6 months, then 5% late cut. If you apply after these 6 months for 12 months, 10% late cut. Basically, 3 years is the maximum time from the end of financial year when you can apply for SEIS. Now, these are nothing but dates extended in terms of late cut, in terms of normal time due to COVID-19. If we are to summarize, as on date, you can file application for 18-19. 18-19 is 19-20, 20-21, 20-22. So 3 years have not gone by. As on date, can you file application for 17-18? 17-18 is 18-19, 19-20, 20-21. Yes, you can file. Can you file application for 16-17? 16-17, 3 years. 17-18, 18-19, 19-20. Period ended on 31st March 2020. It was only extended for 3 months on account of COVID. The application for 16-17 is time barred now. The application for 16-17 is time barred now. 17-18, yes, it is eligible, and 18-19 is also available. And it is available without late cut up till 31st December 2020. So if you have a client and you have to file an SEIS application, you must hurry up, and your target date should be 31st of December 2020. Supplementary claims are not allowed. Suppose while filing an SEIS application for a complete financial year, you did not file for certain, or you could not file for certain export invoices because you did not receive foreign currency. And the formula for calculation is NFE, net foreign exchange. That is foreign exchange received minus foreign exchange paid. Suppose I issued 5 invoices in a financial year, received only foreign currency for 3 during the 3 years, during the next 3 years in which I have to file the SEIS application. then I will not be able to apply for the balance 2, for which I have not received foreign currency. Then if you could not apply, then you cannot apply thereafter. There is no provision for a supplementary claim under SEIS. You have to file once and file once for the complete financial year, no supplementary claims. So if you have not received foreign exchange for certain invoices raised during a financial year, wait for them and then file. Don't hurry up and file, because you will not be able to file another application for the same financial year. Now the question is whether SEIS will be discontinued. Because as on date, if you want to file an SEIS application, you will have a portal facility on DGFT website only for year 18-19. There is no facility to file for 19-20. Although the year has gone by, and we have also, some people must have also received foreign currency, but still you can't file. Why? Notification 57/2015-20, 31st March 2020. Service categories eligible under SEIS and rates of rewards on such services as rendered from 1st April 19 to 31st March 2020 shall be notified separately. So the government is re-looking at the scheme in itself. It is saying that for 19-20 also we will give out a different list of services and their reward rates. And when do they give this notification? They give this notification in the month of March 20, after the year has gone by. So somebody, maybe an exporter like me, has exported services all throughout the year of 19-20, assuming that I will get a reward of 5% or 7%. And maybe that's my margin. And now at the end of the year saying we will notify separately. Why will you notify separately? So, but the government has issued this notification. Somebody wants to challenge it on promissory estoppel, on reasonable benefit, on investment made by you, which is not fulfilled by government, on any of these grounds, you can. But the government as of now has issued this notification that for 19-20, we will decide which all services we want to give, what all rates we want to give. For 2021 also they are saying, or for 1st April 2020 onwards, government is saying we will decide whether we will continue also or not. Although the FTB policy has been, validity has been increased to 31st March 21, but for this they are saying we will decide and we will accordingly notify. So the future of SEIS is under dark clouds, whether it will be continued or otherwise, whether it will be replaced by another scheme or otherwise. Now we come to the last part, and I'll take only 5-10 minutes more to conclude this part. And this relates to our discussion that we left halfway through regarding discontinuation of MEIS. And I only stated a statement, or I only gave a statement that MEIS is discontinued with effect from 1st of April 2021. With effect from 1st April 2021, any exports that you make will not be eligible for MEIS. Let's trace it back to a short history that this MEIS has in terms of its discontinuation and replacement with a scheme called RoDTEP. Basically, in March 2018, USA filed a case before WTO. How did it file? India is a member country of WTO and is also a signatory to Subsidy and Countervailing Measures Agreement, SCM agreement. This SCM agreement provides for provisions as to which country can impose what type of countervailing measures on imports. That is, suppose if I want to impose a countervailing, as India, I want to impose a countervailing measure on imports of television by China or exports of television into India by China. I can have a safeguard duty, anti-dumping duty in order to discourage those imports because it is destroying my domestic industry. Or if I want to, as India, I want to export, promote my export, I can give out certain subsidies. Now, those two subjects of safeguard duties or countervailing duties on imports and subsidizing exports is subject to provisions of SCM agreement to which India is a part. United States of America challenged before WTO that these schemes, which schemes? MEIS, Special Economic Zone, EOU scheme, and EPCG scheme, are in violation of this agreement and therefore should be withdrawn by India. What was the violation? They say, as per Article 3.A of the Subsidies and Countervailing Measures Agreement, member country shall neither provide nor maintain subsidies contingent on upon export performance. So this agreement provides that member country should not give subsidies based on how much you export. Subsidies can be based on whether there are taxes embedded which are going as embedded cost in the product. Subsidies cannot be given on the basis of targets because we want to have everybody, WTO wants to have everybody as a fair player. But there is a proviso to this article, and this says developing countries not having GNP per capita in excess of 1,000 per annum, $1,000 per annum, are exempted from complying 3.1A till the expiry of 8 years. Now, what has happened is India is a developing country, but it has crossed that GNP of $1,000, fortunately. But unfortunately, because we have crossed, this clause applies to us. And therefore, we can't, as India, give export performance, export subsidies, export incentives based on targets. Until and unless we justify that it is on account of some duties that are there which we want to refund. And now these schemes that we have discussed, MEIS, SEIS, has nothing to do with duties embedded in the product. It is saying you export, we will give you money, target based. So this was challenged and successfully challenged by USA. And in March, so it was challenged and successfully challenged by USA before the WTO. Government realized that they don't have a case in it. So even before the decision could come by the WTO, in 2019, government introduced a new scheme called rebate on central and state and central taxes and levies, RoSCTL. This scheme, that is rebate on state and central taxes and levies, RoSCTL, was introduced in replacement to MEIS scheme on only apparel and made-up sector, ready-made garments sector. So with effect from whatever date, apparels, ready-made garments when exported were not eligible for MEIS, but eligible for a new scheme refund or new scheme reward called RoSCTL, rebate of state and central taxes and levies. Now this scheme when introduced said that we are giving out a refund or reward in the form of duty credit scrips against some central and state taxes and levies embedded in the articles which we are not able to refund by way of IGST refund or SES refund or any other refund that we give under various statutes. So maybe there are taxes called mandi tax, some petroleum tax, some sugar cess, some coal cess, some rubber cess, which we would not refund to the exporter. And it was there in the value chain. So we want to refund that, and therefore they gave out this scheme and they introduced the scheme in March 19 and replaced this scheme with MEIS. Now this scheme was in compliance with WTO and SCM agreement because it is now not giving target-based incentives, but it is giving out benefits, not benefit, it is giving out refund of embedded taxes, which is allowable as per WTO because you have to export the goods and not the taxes. But this scheme was only introduced for ready-made garments, for garments, apparel and made-up sector, some chapters under the garments chapter. In October 2019, WTO said that India has violated the provisions of SCM agreement and therefore it should within 90 days of the date of the decision of the WTO shall withdraw the scheme such as EOU, EPCG, MEIS and others. Although this decision did not apply on SEIS, but government has otherwise taken a decision to not continue with SEIS. I can't say not continue with SEIS, but they are due to take a decision on to continue with SEIS or not. But MEIS for sure was in violation of WTO's agreement. Therefore, India on 14 September 2019 introduced another scheme similar to RoSCTL. Now it was a general scheme applicable on all types of goods. This is called Remission of Duties and Taxes on Exported Products Scheme, RoDTEP, not RoSCTL, RoDTEP. this scheme was introduced by the government of India. Although against the decision of the WTO, India has filed an appeal before a appellate forum in WTO, but that appellate forum is dysfunctional. It is not functioning. So you can't expect a decision from them, favorable or otherwise, any soon. And government realizes that there was a problem in MEIS and SEIS, but SEIS was not certain. MEIS and various other schemes wherein we were giving target-based incentives and not linking them with taxes. And that is why they came out with a new scheme. The scheme is to give out the same thing, but now with a nomenclature so as to satisfy the SCM agreement. Wide notification 30/2015-20 dated 1st September 2020. What did they do? They had already introduced a RoDTEP scheme. That scheme was to be formalized under the foreign trade policy, not yet formalized. They have just given a cabinet approval and it is to be formalized. Now, in line with that, what they have done recently on 1st of September, they have said that MEIS shall be discontinued from 1st January 2021. And obviously, from 1st January 2021, it will be replaced by remission of duties and taxes scheme. Remission of duties and taxes on exported products scheme. What they have also done in terms of MEIS, they have said that for any export made between 1st September to 31st December 2020, the MEIS reward will be restricted to 2 crore per IC and subject to a maximum overall payout from the government of 5,000 crores. So suppose the applications for export for MEIS for exports made from 1st September to December 20 comes out to be 5,500 crores and government only can give 5,000 crores due to some budget constraints. That 2 crores limit will be proportionately reduced. Further, the government said we are discontinuing MEIS from 1st January 21 and we will also not give MEIS to people who are new exporters with effect from 1st February 2020. So if you have become an exporter from 1st February 2020, no MEIS for me for the 3 months. Even if I was an exporter prior to that, but I have not made any export in the past 1 year, from 1st September 2020, 1 year backwards, I have not made any exports. I will not be eligible for MEIS on the exports made by me during this last quarter or the third quarter of the financial year 2021. So this is nothing but a transition, wherein they are saying that we had a scheme which was not compliant. We have realized this. Now we are coming out with another scheme which is compliant, which is nothing but in the nature of remission, refund of taxes embedded in a product which is to be exported. We will most probably get this scheme from 1st January 2021. That is why, because it is a replacement of MEIS scheme, we are discontinuing MEIS scheme from 1st January 2021. For the last quarter, please bear with us. Please have mercy with the government. We have budget constraints. We have lost a lot of money in buying PPE kits and masks. And therefore, our budget is 2 crores per IEC subject to a maximum payout of 5,000 crores. And that is the sole reason why there is also no list for SEIS for 1920. Because obviously there are budget constraints in government exchequer's account. Now, March 2020, Union Cabinet has given this approval to replace MEIS with RoDTEP with effect from 1st January 2021. As I told you, this scheme is nothing but a scheme in replacement of MEIS, wherein the aim is to reimburse various embedded taxes which do not otherwise get reimbursed. Like, suppose there is a coal cess, there is a local tax, there is a mandi tax levied by APMCs, there is electricity duty on electricity bill. So any taxes, small taxes, which do not get refunded in any other taxing statute, which get embedded in the product, those are as the target taxes in order to justify the scheme called RoDTEP, remission of duties and taxes on export products scheme. In line with the scheme, and a hint to the scheme is an amendment made by Finance Act 2020, Section 51B has been inserted in Customs Act, wherein an electronic duty credit ledger has been introduced. So in this scheme, instead of giving those scripts, this amount of duty credit that you will get as RoDTEP will be credited to your customs electronic duty credit ledger. So they are just digitizing it. Instead of a paper or a printout, they are giving it in a credit ledger, which has been introduced by way of Section 51B in the Customs Act. Same as MEIS, it would nothing be a, it would be a scheme wherein duty reward will be given, which would be most probably transferable as a percentage of the FOB value of the exported goods. But because it has to be justified with a rate, sorry, it has to be justified with the embedded taxes. That is why it seems as if the rate under this scheme would be less than what was under MEIS. MEIS used to be 2, 5, 7. These were the rates. And in this, because it is to be justified with embedded taxes, with the proper data and everything, it seems that the rates will be lower in RoDTEP compared to MEIS. This scheme will play around with regular refunds under GST as well as drawbacks under the customs law. Now, if you have to compare MEIS and RoDTEP, they are basically the same. The only difference is in the justification of the scheme and maybe the rate for scheme. And that the script given under under MEIS was a printout, was a paper. Here it is in terms of a entry in the duty credit ledger. Now, what's going on in terms of this scheme these days in the present scenario? What is going on is that because this scheme is yet to be introduced in terms of formalization of law, and the rates have also to be notified. What the government is doing is that CBIC has formed a RoDTEP committee, which committee is interacting with trade and commerce bodies, stakeholders, big companies, export promotion councils, various others, to get what? To inquire for data to justify these embedded taxes. To justify these embedded taxes. All these embedded taxes. So if you are an exporter, you are a big exporter, and you want your product to be having a higher RoDTEP rate. So for a function from your side should be, you should collect this data of embedded taxes and give it to this committee, so that the rate that comes out ultimately under RoDTEP scheme is a higher rate for your product. So in terms of a business opportunity as chartered accountants, or maybe an opportunity as an industrialist, as a person who is working in the industry, that you should approach this committee if you want a higher rate for your product. Take out this data, give out the relevant data for a better rate for your products. The latest information that they had inquired was in the month of August 2020, which was to be submitted within 2 weeks of August 2020. I'm not aware if they are still taking the data, but I guess they are still taking the data. They have a specific format of also giving this data of embedded taxes. So as a last word, I would say that for an effective replacement of MEIS to RoDTEP, you should move forward and submit this data to have a better rate under RoDTEP. Thank you, Aditya. Thank you all for the patient hearing. It was my pleasure to always interact at this forum with Aditya and many others. And Aditya has been taking it forward in a spearheaded manner, and younger to me, but he is doing very well and much better than me in the industry and serving the industry. We are only taking 1 or 2 lectures. He is devoting all his time to conglomerate us and do the needful for the practice and the profession. Thanks, Aditya. Thank you, Professional Times. Over to you, sir.
Thank you so much, Saurabh for such a kind word, sir. Uh, this is totally your I would say humbleness that you are. I am very much younger to you, sir, and I have to learn many things from you yet, sir. And I sincerely thank you for giving your regular time to our channel. It is always great to interact with you. Every time I discuss any provision with you, sir, it is like a uh, analyzing a new provision in a different way. Like you said, in the SEIS scheme, we discussed for a client that he was exporting consultancy services to US, but he was not having IEC. So
Yes.
definitely, I think first of all, there is lack of awareness of this SEIS benefit to, I think, if I'm not wrong, I think only 10% of the eligible exporters of this scheme are aware of this benefit, and
Correct.
it is totally, I think, not justified from the government perspective, denying the benefit to these exporters merely on the ground that they are not having IEC. So I think uh,
Correct.
definitely our viewers who are having these type of clients should come together, and I think you and your team can definitely, our team also can help uh, to synergize the benefits for our professionals and their clients. Also, we can take a help from
Sure.
Single G. So now I would request CS Shivangi Agarwal, our core team member, to give a vote of thanks and end the session. Over to you, Shivangi.
Yeah. Thank you, Aditya. Thank you so much, Saurabh sir, for providing such great
Thanks, Shivani.
insights on various on this series that we have started, the Professional Times on foreign trade policy. It was great to hear you. It's great to see such passion and such great knowledge on this matter. Even I was engrossed in it, and I actually liked it, and I hope all our viewers would have appreciated and would have liked all your thoughts and all your insights on it. And thank you so much, sir. Thank you so much. And sir, we can see that you have regularly uh, provided such webinars to Professional Times and giving your uh, information and all your knowledge on such topics. And thank you so much, sir, for taking out your time and enlightening us. Thank you so much, sir. And
Thanks, Shivani. Thanks for the opportunity. Thanks.
thank you so much, sir. And so, continuing with this FTP policy series, tomorrow we'll be having a webinar, which would be conducted by CA Pankaj Jain, Director EY, and he would be speaking to us on EPCG scheme and MOOWR scheme to 2019. So, looking forward to everyone to attending the webinar tomorrow. And for more latest updates and for all the information related to the webinar, please subscribe and like our channel, Professional Times, on YouTube and Facebook. Keeping in mind the Navratri festivity and the holiness spirit, thank you so much all for attending this webinar today, and all the viewers. Thank you so much. And please keep watching Professional Times. Thank you so much.
Thank you, Saurabh sir. Thank you, Shivangi.
Thank you, everyone.
Goodbye, sir. Good night.